Welcome everybody to VTS Options. So among all the questions that I get from people interested in learning how to successfully trade options, by far the most common is, what is my favorite strategy? What's the best trade? Well, I personally, like many, I strongly believe in diversifying across multiple different strategies. I always say, as option traders, we do need a full toolbox at our disposal. We can't just have a hammer. We can't get by with just a single screwdriver. We need multiple tools so we always have the right one for the job, the right tool for the specific market environment. Having said that, naturally everybody's going to gravitate towards a few of their favorites. That's normal. And for me personally, the short Iron Condor is right near the top of the list. In fact, one of my earlier trading websites over 8 years ago now was called theironcondor.com. So this is a trade that's near and dear to my heart, and I want to teach it to you today. So subscribe to the channel if you haven't already, smash that like button for me, and let's get into the short Iron Condor. Now, the Iron Condor is definitely considered one of the more advanced option spreads out there, but don't let that discourage you. It's actually a lot simpler than it may appear on first glance. We can open and close these in a single transaction, so practically speaking, it's as easy to trade as any other option type. It's all bundled into one trade. Now, I will dive into my trading software shortly and go through a full example, but right now let's break down what the Iron Condor actually is. It's constructed by selling both a short vertical put spread and a short vertical call spread, both of those for the same expiration. Again, it's just a simple transaction, so it is easier than it looks. But when we do that, here's what that trade looks like. Now, I say short Iron Condor here because you can also trade them on the long side. But for me, I rarely open long Iron Condors. When I'm speaking, for my videos and in my blogs, I just say Iron Condor. Always just assume that when someone says Iron Condor, they mean it's on the short side. So on the horizontal axis here is the price, and on the vertical axis, the profit. Now, one of the big benefits to the Iron Condor is that because it's opened with two vertical spreads, which are limited loss trades in themselves, the Iron Condor as a whole is also a limited loss trade. We know exactly how much we can potentially lose right from the outset, so managing risk is much easier to define. And the maximum gain for the same reason is also known in advance. So limited gain and limited loss, defined at the outset of the trade. Now, because Iron Condors will always be closed out well before expiration, at least that's how I trade them, that means the expiration risk profile there is irrelevant. The only thing we focus on is the daily profit curve, which is that pink line. The trade is managed entirely based on that, and I'll explain what it is in my example shortly. But first, let's quickly talk about the Greeks. The Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. We have price, time, and volatility. Delta is an option sensitivity to price. Iron Condors are delta neutral, also known as market neutral, and the trade profits from a lack of movement in the underlying. So we are indifferent to direction here. Up or down is fine, as long as it doesn't move too far in either direction. It's delta neutral. Theta is an option sensitivity to time. Iron Condors are theta positive, meaning the position gains value with the passage of time. Every day that goes by, the contract does decay a little bit, and Iron Condors benefit from that positive theta. And lastly, Vega is an option sensitivity to volatility. Iron Condors are Vega negative, meaning they benefit from decreases in volatility. This is why it is more advantageous to open Iron Condors during times of higher volatility. The higher it is, the more room there is for it to fall, and the trade can benefit from that decrease in volatility. Okay, so this is the Thinkorswim Platform from TD Ameritrade, and I'm just going to go over a standard short Iron Condor. Like I said, all Iron Condors from my perspective are on the short side, so I'll just say Iron Condor. But we're looking at the S&P 500 here, and you can see the huge crash that we're experiencing right now in 2020. At the low yesterday, the stock market was down 34%, so clearly volatility is going to be sky high. Now, when I went over the option Greeks, remember this is a Vega negative trade, which means Iron Condors tend to perform better during higher volatility environments. When you sell volatility and it's this high, it does allow you to make the wings of the Iron Condor pretty wide. Now, I should say that I'm only going to be going over this briefly. It's not really going to be actionable because I'm not going to cover all aspects of the trade. But within the VTS Options community, this is a blog from a couple of weeks ago, every single trade I take has a full blog article attached to it. So I'm going to write something about why I think the trade is a good one. I go through the full trade details so people can always execute these easily in their trading software. The strikes, the dates, all the prices, plus a risk profile chart. I go through the margin requirements so people understand how it's going to affect their buying power. There's a section for risk management. I'll talk about how we're going to manage the trade day to day, whether we're going to use stop losses or not. In this one, there were no stops, but this is the section that I'll talk about risk management. Allocation sizing is very important. We have to know how big or small the trade will be in relation to a broad portfolio. Go over the Greeks. Those are always nice to know what side of the trade you're on. I'm big on volatility metrics, so I've got a few listed here, but I've got dozens of these with articles for each, and people can actually learn about the volatility metrics. This first one here, the Volatility Barometer, it does have a separate video that I think you should probably check out. You can search my YouTube channel. It's just called the VTS Volatility Barometer. But that's a good video to check out. And then at the very bottom, of course, we've got all the open positions, including any new actions that we're going to take. So just know that I am a person who believes in comprehensive coverage of each trade. I don't just fire off trade ideas and let people figure it out for themselves. But for this example, just to keep things short, I'm just going to go over a basic example. So we're going to go to the Analyze tab here. Going to add simulated trades. We're doing the S&P 500. This is the SPY ETF. And these are all the available monthly expirations. Now for me, I do like to keep my Iron Condors a little bit further out in time. I tend to target about 45 to 75 days to expiration. So I'm tempted by this June 86, but it's a little far out, so I'm going to have to go with this May 51. 51 days to expiration, it'll be fine. Scroll down to something near the money so we can actually open this trade. And right here, you just highlight, your software will be about the same, but I'm just going to sell to open an Iron Condor. And this is what the risk profile looks like. Now, of course, this is just a sliver. We have to adjust these strike prices. But we're right around $250, so I'm just going to go $50 up and down, and we're going to sell the original call at $300. And then just go $5 above that, and we're going to find the 305. On the put side, we're just going to drop at $50. Keep things even on both sides. 200, and then again, $5 strike gap. We're going to find that 195. So this is the familiar risk profile of the short Iron Condor. Now just to explain what we're looking at here, we've got a single contract, we've got the May expiration, all the strike prices that we just selected. Of course, one of them is a vertical call spread and one of them is a vertical put spread. And then we've got the credit here. This is how much premium we're going to be collecting for the trade. Because we have a $5 strike gap, if we bring in $1.14, I'll just lock that so that it doesn't move around. If we bring $1.14, that means $114 per contract. You can see the prices down here, the turquoise. See, it says $114. That's how much the trade can make per contract. Now the loss is the strike gap minus the premium we bring in. So this trade can actually lose $386 per contract. Now this is something that often confuses newer option traders. They look at this risk profile and they think, well, how is that a good trade? I can lose far more money than I can make. And that's true, this can. If left to expiration, that could happen. But the key to Iron Condors is, we don't let these go anywhere near expiration. We close them out well in advance of that. So actually this turquoise line for the risk profile, that is irrelevant. We are only going to be managing the trade based on this daily profit curve, this pink line right here. You can see when they open the trade, it's going to be about zero. Price is moving around slightly right now, but it's about zero. And as the price of the S&P 500 moves around day to day, we're going to be able to use this pink line to see how much money we're up or down. And when I'm trading Iron Condors, I very often use what's called stop loss and stop gain. For me, I like to use 50% of the premium. So the stop loss will be 50% above the premium we bring in. If it's $1.14 times 1.5, we're looking at about $1.71. If it gets to that price, we're going to close this trade for a loss. And then I also use a stop gain. So $1.14, 50% of that, we're looking at about 57 cents. So if this premium gets to 57 cents, we're going to take the profit and close the trade. Now, one thing I like to do personally, because we're looking at 57 cents per contract as the stop loss, $57 per contract, we can just find that on this pink line. So you can just scroll down to about there, and I can adjust these hash lines right on that stop loss level. So we'll find 57. And now I can see at a quick glance, that little hash mark is where the price is now. I can just follow this day to day, and as long as it doesn't breach either one of these stop losses, I can leave the trade open. Hopefully the price just continues to rise towards this level, and we can close it for the stop gain, and we can make the profit. But it's very important that traders understand when you're trading Iron Condors, sure, if you let them go to expiration, then you're in a situation where you can lose far more than you can gain. But if you use a 50% stop loss and stop gain, essentially now this is a 50-50 trade. And since we've opened it and we've used the Greek symbols in our advantage, we should have much better than a 50% chance of making profit. And then when you open these over time, if you open enough of them, in the long run it adds up to a really great rate of return. Now we can put this trade on the original chart that we were looking at just to show you how wide these wings actually are. So remember, the put strike is down about 200, that's pretty much at the bottom here, starting there, and then all the way up at 300 here. So this is what we're looking at, May expiration, the current price of the SPY is right here, so this is essentially what our trade looks like. We're just betting that the stock market will be trendless for a little while, and we can collect the profit. Now, of course, it's trading and anything can happen. The stock market could absolutely collapse here and we would take the stop loss. And vice versa, it could just recover very strongly and we would stop out as well. But given where we are in the current market, I look at things basically that right now, given the magnitude of measures the Fed and the government are willing to take here, even if stocks start to collapse, there probably is a little bit of a floor there. And on the flip side, no matter how strong the recovery gets, we are still heading for some very grim economic numbers, so it'll probably reduce how quickly the market can actually recover. We may be in a situation where the markets are just going to chop around plus or minus 10 or 15% for several months. And of course, that's what the Iron Condor is good for. It's a market neutral trade. Remember, we can look at the delta here. You can see right there, it's going to be about zero where the price is. We don't really care if it goes up or down, we just want it to stay in this center range. It's a market neutral, delta neutral trade. The other important Greek is theta. We can see here, theta positive, $1.74. Now that doesn't seem like much, but that is a daily theta decay and it does rise exponentially the more days that pass. But essentially it just means that every day the market remains trendless and we just chop around here, we are collecting money every day. That positive theta is a big advantage in these types of markets. And lastly, Vega. You can see it is a Vega negative trade. Right now, about minus 4.22. This means every percent that volatility in the market drops, we can actually collect $4.22 per contract. When volatility is this high, that Vega can really work to our advantage quite quickly. So like I said, in my daily blogs, I definitely go over these in a lot of detail, covering it from all angles. But that is the basic Iron Condor. And actually, today's a really good day for me to open it, so I am going to be taking this trade in the VTS community. I like the fact that yesterday the stock market bounced pretty strongly. You can see we came off the bottom here, and now we're much more in this middle range. Despite what a lot of people talk about being a market crash being negative, actually the danger to Iron Condors is the market trending really strongly upward. That's when you can get stopped out pretty quickly. If markets go down, volatility remains elevated and there's plenty more follow-up trades we can do. But when the market's going up, that can be a little bit dangerous and you can get stopped out pretty quickly. So I don't particularly like opening Iron Condors when you're at the very bottom of a range. I do like to see a little bit of a recovery, and then you jump in when it's more centered here. So it does appear to be a pretty good day, and I'm excited to get into this trade soon. So that's a basic example of the great and powerful Iron Condor, a personal favorite of mine. Just to review those points, Iron Condors are delta neutral. They are market neutral trades where we're looking to benefit from the lack of movement in the underlying. This means it's great for choppy markets, and in my opinion, a great addition to any portfolio because they do typically show a lower correlation to the S&P 500. So it's a great diversification tool. Iron Condors are theta positive. They benefit from the passage of time. So we can set them up, and if there's no clear trend in the underlying, we can just collect that daily decay. They're also Vega negative, which like I showed, that does allow us to set those wings a little bit wider and then profit from the eventual decrease in volatility. And lastly, they are both limited gain and limited loss trades, so risk is well defined. Risk management is largely managed through proper position sizing and honoring those stop losses. As option traders, we do need a diverse toolbox, so we always have the right tool for the job. And the Iron Condor is right near the top of the list of usefulness. We trade these often in the VTS community, so go ahead and claim your free trial on my website and come check out some of our live trades. Thanks for watching. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: Iron Condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.